Welcome to Intelligent Investor Insights with Joshua Barone, your host and guide through the noise of today's markets. Here, we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
Hey everyone, Josh Barone here. Welcome to another round of Intelligent Investor Insights. I know that title, AI Capital Sins and Market Realities, sounds a little, well, hellish, and that's on purpose. I want you to picture Dante at the entrance to Inferno. Abandon all hope, ye who enter here. Dramatic? Maybe, but honestly, that's what keeps rattling around in my head every time I look at these AI markets lately. Now, you probably don't need me to tell you that NVIDIA is the sun around which the market orbits right now. Everybody's fixated on the stock chart climbing to celestial heights. It's the closest thing we've got to a digital deity at this point. But look, those climbs, they cast a long shadow. And what's in the shadow? Structural risks, debt stacks, power constraints, these agentic AI processes chewing through resources like Pac-Man on a power pellet bender. Seriously, it's gotten easy to lose the straight path of rational investing, like tripping off into a dark wood where you might not even notice you're lost until you're shin deep in quicksand. I'll own it. Back in the day, I fell for a couple tech fads myself. Didn't matter how many times my father whacked my knuckles for a sloppy GDP take, I still thought every shiny thing was a shortcut to riches. Spoiler alert, it wasn't. That lesson cost me. Call it tuition. These days, discipline comes first, and it's how I keep my own compass pointed north when the hype machine's at full blast. So, with that slightly apocalyptic mood set, let's start digging into the first of our 7 sins. All right, sin number 1, sloth. Dante stuck the lazy way up in the higher circles, running laps to make up for wasted time. But in our corner, sloth takes the shape of software that keeps getting slower, even while our hardware, at least in theory, is racing ahead. Here's the punchline. Wirth's law basically says software is getting slower more rapidly than hardware becomes faster. That's not me being cynical. That's Niklaus Wirth. Look him up. Real Swiss efficiency vibes. This is the evil twin to Moore's law, which everyone worships for its promise of relentless compute progress. Problem is, if software is eating up every little improvement, you aren't getting ahead. You're just running in place, like a hamster on a wheel with a couple too many lines of JavaScript. Gates' law, if you haven't heard that one, claims the speed of software halves every 18 months. So folks gamble billions on the idea that AI compute will eventually be too cheap to meter. Maybe that was plausible when Moore's law was king and Wirth's law wasn't true, but, well, these days, not so much. So ask yourself, if your AI investment just keeps handing the sloth tax down the line, who's actually paying? You guessed it, the shareholders. And if it feels like you're buying an electric car that only gets 2 miles per gallon, you might be living Wirth's law instead of the dream. Now, let's tumble down a level. Gluttony. In Dante's circle, it's all about excess. And no surprise, that fits AI's current appetite perfectly. We're not just binging on compute. We've changed what eating even means. Remember when AI was a neat trick? One prompt, one answer? Pretty lean. But thanks to agentic AI, those days are gone. Now it's chains of thought, elaborate tool calls, full feedback loops, and, surprise, surprise, weekly token usage has spiked 3,800% year over year. I double-checked that stat and still think it sounds, well, gluttonous. But here's the twist. This isn't all genuine demand. Most of it is inefficiency, the snacking of agentic workflows cranking out thousands of actions for what used to be a single decision. You know Jevons paradox? Costs drop, yet total resource use explodes. Classic rebound effect. Even OpenAI's Sam Altman has flagged it. Single inference costs are falling much faster than Moore's law would have predicted. But as soon as it gets cheap, we just find ways to binge even more. So, we're not saving calories, we're just putting the system on an AI diet that snacks 24/7. And we wonder why the electricity bill looks like a mortgage payment. Speaking of bills, let's talk greed. This one's less glitzy, more, oh boy, here comes the auditor. We've got deals like Meta's $27 billion off-balance sheet data center joint venture with Blue Owl Capital, the Hyperion campus. Sounds epic, right? But the real trick is most of that debt isn't on Meta's balance sheet. Only 20% is theirs. The other 80% is tucked into the shadow banking system, courtesy of Blue Owl's funds. It's like asking your neighbor to store your trash, then telling the HOA you're spotless. Meanwhile, the bond market caught a whiff. Those loans priced at yields you'd usually see for junk-rated stuff, because let's be honest, who wants to hold a melting pile of NVIDIA GPUs as collateral? That's what lenders got with the CoreWeave deal last year. $7.5 billion backed by hardware with the shelf life of a banana. Are we running the same playbook as the mortgage crisis? Maybe not apples to apples, but the structure isn't that different. Just swap out homes for silicon that'll be obsolete in 2 or 3 years. Kind of makes you want to check under the hood, doesn't it? Let's dial it down to what Dante considered the real lower depths: fraud. And here's the modern version: significant risk transfers, SRT if you want the lingo. Major banks, I'm looking at you, Morgan Stanley, have been quietly offloading their data center loan exposure onto, guess who? Pensions and insurance funds. So while retail money piles into AI ETFs and thinks it's riding the innovation wave, the smart money's quietly slipping out the back door. Now, ask yourself, if this was the greatest technological revolution in history, why would institutional players be so intent on dumping the riskiest chunks? Well, their quant teams see that power shortages may cap U.S. data center growth, maybe up to a 20% shortfall through 2028. That kind of physical constraint can stop a party fast, and it's a ceiling most folks haven't priced in yet. Bottom line, when the music stops, someone's holding the bag. It just might not be the big banks this time. Could be institutional funds, could be retail investors. History doesn't always repeat, but yeah, it rhymes. All right, let's talk about the ultimate sin: pride. I mean, this is Silicon Valley's house specialty, betting that physical limits don't apply, that we can scale forever. But then you get a wake-up call from Dominion Energy, Northern Virginia's grid operator, who now says connecting a new data center could take up to 7 years. 7! That's forever in tech years. Even the true believers are worried. Anthropic's CEO, Dario Amodei, comes out and says, intelligence isn't magic fairy dust. There are real physical and practical limits. Wall Street, of course, stays bullish, as if we'll just rewire the laws of thermodynamics when the servers get a little toasty. If my dad heard that thesis, he'd have reached for a ruler before I hit the end of my sentence. And here's the thing, you don't get to turbocharge ROI if there aren't enough electrons to power your chips. A GPU without grid access is just expensive sand, no matter how many AI agents you run on top. Plenty of companies ignore this, until the lights flicker. So how do you keep your soul and your portfolio out of this silicon inferno? Well, time to channel your inner Virgil. Human reason and prudence still matter, even if it's not trending on X. Here's my checklist, forged by enough scars and blown trades to make even Dante cringe. First, skip the slothful SaaS wrappers. If a software company's main value is gluing together expensive API calls without real optimization, they're in the crosshairs of Worth's law. If their cost of goods sold rises in step with user complexity, that's a treadmill to nowhere. Seek model distillers instead, the teams figuring out how to shrink massive AI models into leaner, cheaper student versions that actually get better per unit of compute. Second, audit the balance sheet. Is this outfit funding CapEx from real cash flow, or is it a vendor financing smoke show where cash just sloshes around between insiders? If it's the latter, that's not strategy. That's just the same old sin. Third, and maybe most underrated, respect physics. Prioritize companies with proven grid access or who've secured a cooling moat around their infrastructure. A company with real power, literally, is worth more than all the Silicon Valley move fast and break things in the world. Some firms out there are doing this right. There's virtue still, but you gotta hunt for it. Most, they're still trying to hype you back into the dark wood. So look, as we crawl out of the inferno, remember, the path to seeing the stars again isn't paved with FOMO, but with efficiency, discipline, and a little humility. Only the disciplined emerge from the woods. The rest, they're still standing around, waiting for a liquidity event that's never coming. That's all for today. Next time, maybe we'll pick up on the virtues and the rare gems of the new AI economy. Until then, keep your knuckles safe and your checks disciplined. Catch you soon.
Thanks for joining Joshua on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional-level analysis, and a partner in building durable wealth. Reach out to start the conversation and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.